All right, let's dive right in. We're going to be talking about a pretty fundamental shift in how markets are starting to work. It's this whole new world of what are being called shadow signals, and really how the smartest investors are now using prediction markets to get a serious edge. And this quote right here, well, it just gets right to the heart of it, doesn't it? This isn't some hypothetical classroom example. This is something that actually happened. And it perfectly illustrates this new, kind of brutal truth about financial markets. We are absolutely entering a world where classified intelligence doesn't just leak, it gets monetized. In real time, creating these shadow signals that ripple through the market way before the news ever breaks. So, how in the world did this happen? Let's break down the case study that sent shockwaves through, well, both the intelligence community and Wall Street. Because this isn't just some weird one-off event. It's literally the playbook for a brand new kind of insider trading. Okay, so the setting for this whole story is a huge, covert geopolitical event, Operation Absolute Resolve. And this wasn't just some simple raid. We're talking about a complex, multi-month military campaign targeting the Venezuelan leader Nicolas Maduro. Now, to the public, the news of his capture on January 3rd, 2026, was this sudden, super dramatic development that basically came out of nowhere.
But see, for a select few, it wasn't sudden at all. While the entire world was just waiting for a breaking news alert to pop up on their phone, the event itself was already being priced into a very, very specific corner of the market. The real action, the real story, all took place in the 48 hours leading up to that raid.
So this table, this is the playbook. These are the actual trades made by a U.S. Master Sergeant named Gannon Ken Van Dyke, a communication specialist who had direct access to the operations timeline. Using the pseudonym Burdensome Mix, he just started carefully building his positions. I mean, look at these implied probabilities. He's buying yes shares when the public market thinks these events are complete long shots. On January 1st, the odds of a U.S. invasion were priced at just 4%. He knew better. And then his final massive move happened on January 2nd, buying up shares saying Maduro would be out of power for just 7 to 8 cents on the dollar, just hours before the mission even launched.
And what's the result of trading with perfect, non-public information? A mind-blowing 1,200% return on capital. Because when the news of Maduro's capture finally hit the headlines, every single one of those shares he bought for pennies resolved to one full dollar. Think about that. A $35,000 investment turned into over $400,000. But here's the key. This was not a lucky bet. He was exploiting what the source calls the certainty gap, this massive chasm between the reality known inside a secure military operation and the wild speculation happening in the public market. He wasn't predicting the future. He was arbitraging the present.
So this case didn't just expose one rogue soldier, it exposed a fundamental rewiring of our whole information ecosystem. So, what is the underlying market structure that actually makes this kind of information arbitrage possible? Well, welcome to the era of info finance, or InfoFi. This is a whole new paradigm where the old rules of the market are basically being turned upside down. For over a century, right, we've all watched the price tape, the stock tickers, the bond yields as the main source of truth. But in this InfoFi world, that tape is now a lagging indicator. The new leading indicator, the thing you have to watch now, is the probability tape being generated in real time by these prediction markets. And this slide really illustrates the new divide in the market perfectly. On one side, you have retail traders who are always operating on a delay. They're reacting to news headlines, which, remember, come after the signal has already been priced in by the people in the know. And then on the other side, you have the institutional whales. They aren't watching the headlines. They are glued to the probability tape, looking for these shadow signals, leveraging asymmetric data to get way ahead of the event itself.
This is the mantra that gets repeated throughout the source material, and it is the absolute key to understanding this entire shift. You see, there's a three-step delay in how information gets to the public. First, the event happens or becomes certain. Second, the headline reports it. And then third, way later, the traditional price tape finally reflects it. The vast majority of people are trading on step 3. All the real alpha, all the real money is captured back in step 1.
And if you look at the data on who actually makes money in these markets, it is just stark. Look at this breakdown. A massive 92 to 93% of all participants are unprofitable. Why? Because they're reactive. They're trading on those lagging headlines. But then you look at the very, very top, a tiny fraction of a percent, the elite whales. Those are the ones with the asymmetric data. This is a market that doesn't just reward better analysis. It rewards fundamentally better information. Now that Maduro case, it's not some outlier. This whole dynamic of shadow signals front-running traditional markets is playing out everywhere, from geopolitics to global commodities, and the data shows it's creating these huge disconnects with legacy risk models.
So to really appreciate how revolutionary this is, we need to have a benchmark, right? For decades, the gold standard for measuring market fear has been the VIX, the fear gauge. It's pulled from S&P 500 options, and it tells us how much broad systemic volatility the big players are expecting over the next 30 days. It's the old guard of risk indicators. But its weakness is that it's an aggregator. It's like measuring the temperature of the entire ocean instead of the specific volcano that's erupting underneath the surface.
And this slide right here shows a crystal clear divergence. During the Maduro raid, look at the VIX. It barely budged, and its tiny little peak came after the event was already public. It was lagging. Meanwhile, the prediction market probability for that specific event skyrocketed to 88% before the raid. Or, look at the Strait of Hormuz blockade. Okay, the VIX did spike, but the prediction market was right there with it, pricing an 86% chance of conflict, offering a real-time event-specific gauge. The VIX was basically blind to these specific shocks, while the prediction market saw them with near-perfect clarity. This predictive power becomes even more potent when you look at commodity markets. So let's take a closer look at that 2026 oil crisis, which was all centered on that strategic choke point at the Strait of Hormuz. Now, this is where prediction markets provide just incredible value. Instead of getting one stale government forecast, you get a live, detailed probability for a bunch of different outcomes. This table shows that back in April 2026, traders could see a 36% probability of $100 oil. Not just a possibility, but a significant tail risk they could actively hedge. And even more importantly, they saw a 21% chance of $120 oil. What does that signal? It signals that the market was pricing in a very real, full-scale military escalation. This isn't some vague forecast. This is actionable intelligence updated by the minute. So while all the diplomats and politicians were out there jawboning, publicly claiming the conflict would end quickly, the prediction markets were telling a completely different story. The odds for the strait remaining closed just stayed stubbornly high. Institutions that trusted this probabilistic signal, the ones that followed the real money, were able to sidestep a brutal short squeeze when troop deployments were finally confirmed. They listened to the market, not the press conference. But here's the turn. If these markets are powerful enough to reveal inconvenient truths, that means they are also powerful enough to create convincing lies. This new technology comes with a really significant dark side, a whole new vector for information warfare. The source material gives this risk a fantastic name, prediction laundering. And it's the process of taking a subjective or biased or even a completely fabricated position, pushing it through the market with enough money, and having it pop out on the other side looking like an objective, crowdsourced probability. This process has a really distinct four-stage life cycle. So let's use a hypothetical to make it super clear. Imagine a bad actor wants to create panic about a company. First, structural sanitization. A platform allows a market on whether that company's CEO will be fired. Second, probabilistic flattening. The bad actor places a massive anonymous bet that yes, the CEO will be fired, which drives the probability way up to, say, 75%. Third, architectural masking. The platform structure might make it look like this huge bet is actually coming from tons of different sources, creating this false consensus. And then finally, stage 4, epistemic hardening. The financial media reports on the high probability of the CEO being fired, investors panic, the board gets nervous, and a self-fulfilling prophecy begins, all based on a signal that was totally manufactured. The number one danger for anyone using this data is what the source calls epistemic vertigo. It's that disorienting state where you genuinely can no longer tell the difference between a real market signal and one that's been deliberately manipulated. You mistake a manipulated price for objective truth, and you end up making critical decisions based on a lie. So with all this incredible power and this profound risk, what's the new playbook? How do sophisticated investors operate in a world where the future is probabilistic and truth itself is now a tradable asset? Well, the single most important conclusion is that the game has changed, period. The old price tape has been replaced by the new probability tape. Generating alpha isn't about executing on known data faster than everyone else anymore. It's about correctly identifying and auditing these signals as they move from secret knowledge into the public market. And this new reality gives rise to a completely new institutional strategy. First, they isolate that certainty gap we talked about. Second, they use these markets for super capital-efficient hedging. Third, and this is so critical, they actively monitor for whale signatures, these sudden, huge transaction clusters in tiny markets that could signal the flow of asymmetric, even military-grade information, just like we saw with Sergeant Van Dyke. And finally, and maybe most importantly, they audit the laundering cycle. They don't just blindly trust the number. They ask, who is behind this volume? What is their motive? Is this a real signal or is it a mirage?
All of this leaves us with a final, pretty provocative question. In a world where secrets are monetized in real time and probabilities can be completely manufactured, what is the true price of truth? Prediction markets have created a marketplace for future knowledge, no doubt. But in doing so, they've also shown us that truth itself can be bought, sold, and shaped by those with enough capital and conviction. And figuring out which is which, well, that's the new frontier of alpha.